Hey, what's up, everyone? Ralph here. So I came across this article on CNBC, and it talks about how the Feds expect the banking crisis to cause a recession this year. Now, we've all heard it before, right? We're in a recession. We're not in a recession. We've got people actually changing the definition of what a recession is. Regardless of whether we're in a recession or not, we understand people's pockets are hurting, right? People are struggling to make, to buy the things that they need. People are living paycheck to paycheck. People are using credit cards to fund their lifestyle. So we know that people are struggling financially and people are stressed. I think I even read an article talking about how 70% of Americans are stressed financially. Now, obviously, financially stress is a subjective term. There's different levels of it, but it just gives you an idea of what people are feeling when it comes to their finances. So let's get into this article and just see what they're saying and what they're talking about. So it says the fallout from the U.S. banking crisis is likely to tilt the economy into a recession later this year, according to Federal Reserve documents released Wednesday. Minutes from the March meeting of the Federal Open Market Committee included presentation from staff members on potential repercussions from the failure of Silicon Valley Bank and other tumult in the financial sector that began in early March. Though Vice Chair, the Supervisor Michael Barr, said that the banking sector is sound and resilient, staff economists said that the economy will take a hit. And you got other people talking about how the banking crisis isn't over. I think I even read something about Warren Buffett saying that the fallout from the bank is still not finished. So there's some people that still think that there's still more issues that's with the banking industry. So a lot of people think there's more to come. So obviously you gotta get ready for that. So it says, given the assessment of the potential economic effects of the recent banking sector developments, the staff projections at the time of March meeting included a mild recession starting later this year with recovery over the subsequent 2 years, the meeting summary said. Projections following the meeting indicated that the Fed officials expect gross domestic product of just 0.4% for all of 2023, with Atlanta Fed tracking first quarter gain of around 2.2%. That would indicate a pullback later in this year. The crisis had caused some speculation that the Fed might hold the line on the rate, but officials stressed that more needed to be done to tame inflation. So I think I remember, I think the Silicon Valley Bank thing happened in March 10th, and I think a couple of weeks after that they had another interest rate hike. But I think a lot of people were worried that because of the interest rate hike, it was a reason why some of the banks were failing. And what they wanted to do is they was like, all right, Feds, just hold off on another interest rate hike that would have came in April, which is this month. But I think they wanted the Feds to hold up and just make sure there's no other fallouts when it comes to banks. So I guess a lot of people were talking about how they were asking the Feds to just not do any interest rate hike for the month of April, just take a pause just to see how if there's any more fallouts when it comes to the bank. So, but I think there's going to be another one in May. I think about 0.25% that they mentioned. So, but yeah, you can see that I guess the Feds, they were asking the Feds to just hold on, and some people think more should be done. So the FOMC officials ultimately voted to increase the benchmark borrowing rate by 0.25 percentage point, the ninth increase over the past year. That brought the Fed funds rate to a target range of 4.75 to 5%, and the highest level since late 2007. I think that was the one in March. So it says the rate hike came less than 2 weeks after the Silicon Valley Bank. At the time, the 17th largest institution in the U.S. collapsed following a run on deposits. The failure of the SVB and two others spurred the Fed to create emergency lending facilities to make sure banks could continue operations. Since the meeting, inflation data has been mostly cooperative with the Fed's goals. Officials said at the meeting that they see prices falling further. Reflecting of the effects of less projected tightness in product and labor markets, core inflation was forecast to slow sharply next year, the minutes said. But concern over the broader economic conditions remain high, particularly in light of the banking problems. Following the collapse of SVB and other institutions, Fed officials opened a new borrowing facility of banks and eased conditions for emergency loans and discount loans. The minutes noted that the program helped get the industry through its troubles, but officials said that they expect lending to tighten and credit conditions to deteriorate. So I think I also read another report how obviously they're tightening credit. So if you're someone that's looking for maybe a loan or you're obviously looking to get a mortgage, you're looking to purchase a home, it's gonna be unless your credit is I mean, obviously your credit score got to be on point. It's got to be a pretty good score in order to make sure that you get credit for to get a loan for these things that you want to buy. So because they're gonna be tightening up, because obviously you have the recession, you got inflation going on, so they're worried about obviously the economic conditions. So if you're someone that's looking for to purchase a home or get an auto loan, which I don't think a lot of people aren't right now because of the high interest rates, but if you're someone that is, then you want to make sure you got obviously that good credit to make sure that you get the best rate possible. So, because they're tightening credit right now, they're tightening lending conditions right now. So even with the actions, participants recognize that there was a significant uncertainty as to how those conditions would evolve, the minute said. So it says, like, several policymakers questioned whether to hold rates steady as they watched to see how the crisis unfolded. However, they relented and agreed to vote another rate hike because of elevated inflation, the strength of the recent economic data, and the commitment to bring inflation down to the committee's 2% longer run goal. So obviously they're trying to get that that inflation rate down to 2 to 3%. So in order to do that, they're gonna have to keep raising that interest rate. So I think there's gonna be another 0.25% in May, and then who knows what's going to happen after that. But obviously the goal of the Feds is to get that inflation rate down to 2 to 3%. So who knows how long that's going to take. There's probably going to be a lot of economic pain before we get there. So definitely make sure that your funds are tight, and make sure that you're not stressed financially, like a lot of reports are saying. So it says, in fact, the minutes noted that some members were leaning toward a half-point rate rise prior to the banking problems. Officials said inflation is much too high, though they stressed that the income and data and the impact of the hikes will have to be considered when formulating policy ahead. Several participants emphasized the need to retain flexibility and optionality in determining the appropriate stance on monetary policy given the highly uncertain economic outlook. Inflation data has generally been generally cooperative with the Fed's aims. The Personal Consumption Expenditures Price Index, which is inflation gauge policymakers watched the most, increased 0.3% in February and was up 4.6% on an annual basis, the monthly gain expected. So it says there are some bad news on the inflation front. A monthly survey from the New York Fed showed that inflation expectations over the next year increased 0.5 percentage point to 4.75% in March. Markets as of Wednesday afternoon were signing about a 72% chance of one more quarter percentage point rate hike in May before the policy pivot where the Fed cuts before the end of the year, according to CME. Though the FOMC approved the increase in March, it did alter language in the post-meeting statement that previously ongoing, yada yada. But yeah, so I guess what it is like, obviously no one knows what's going to happen, whether we're in a recession or not. Whatever people want to call it. Like, obviously people are struggling and people are trying to figure out how to get by. So what I recommend, like, look at me, if you have debts, obviously try to pay those down, because it's hard to get yourself organized financially when you have to have so many obligations to, like, mortgage, your car loan, credit cards. These are so many obligations that we have to pay. And if you're stressed out financially and you don't have the money to come up with to make all these payments, it's going to be difficult for you when prices get higher. Obviously summertime is coming around, so you're going to expect gas prices to go up. So it's going to be more economic pain. So you want to make sure you put yourself in a position where you could weather that storm, how long that storm lasts. So and it's going to be tough because like I said, a lot of people are living paycheck to paycheck. They have a lot of obligation, and it's hard to come up with the cash in order to make these obligations. So yeah, so that's all I got for you guys today. If you got any comments or questions, make sure to leave it down below. Hit the like button, share. And if you haven't done so already, please don't forget to subscribe. All right, so you guys take care and have a good one. Later.